like, hey, these idiots don't know how to use their technology.
There we go. Welcome to another week of the Educated Homebuyer Live. This is a holiday edition. It's our July 4th edition. We're celebrating America's birthday. We're answering your mortgage and real estate questions live, talking about the economy. We're going to have some fun. So thank you guys for joining us. Josh, welcome to another week.
Jeb,
welcome to another week. I mean, it's
we survived. We survived another week, so we're happy about that. The funny thing is, for those of you on the other end, our little technology on this end does a countdown timer, and then when it gets to 0, it says it's showtime. And in my brain, that was the countdown timer for 1 hour from now, and it's 4th of July, and we get to walk out the door and celebrate America's birth.
There we go. So, you guys, wow. You guys, the show is all about answering your questions, so you can start putting them in there now. We'll do as we always do, and start with some slides, go through inventory, go through what's happening in the economy. We did have some data come out this week that is in favor of a slowing economy, which in turn should be more favorable for mortgage rates, and we'll talk about that. But before we do that,
should be is the operative word.
Should be. But before we talk about that, Josh, this past week on the Educated Homebuyer Live podcast, we talked about the loan estimate. We went through the loan estimate in detail. The episode didn't do very well, quite frankly, where we walked through it. But if you are getting a loan, don't understand the cost, want to know how to shop loans, that's an episode you want to pay attention to, because it really dives into the details of what you as a buyer should be paying attention to and really what to focus on at the end of the day. So if you haven't gone and listened to that, do us a favor and check it out on Spotify, on YouTube, wherever you listen to us. So Josh, let's do what we came to do and look at some charts. So this week, we're looking at 646,000 single family homes on the market at this time. That's up 1.8% for the week, and 39% more inventory than just a year ago. But you've heard us talk, that 39% increase is primarily focused in Florida and Texas. So you got 2 states really pushing the majority of the increase in inventory, and we'll talk about that here in just a minute. Orange County sitting at 3,012 listings. That's down just less than 1% week over week. Huntington Beach down 2.84% week over week, sitting at 176 listings. Here's the thing. It's a holiday week. If I were listing a property, I would not have listed it this week. So I think you're going to see numbers increase again next week. You're going to see inventory rise again, because this is just a slow week in inventory. Not, people aren't in the market of putting their homes on the market this week. They're vacationing, they're celebrating, they're out with friends and all of that good stuff, and not really house shopping so much or selling houses. So I expect the numbers to go back up again next week, but we will see.
Jeb, yep. I have a comment. You know how your friend can send you a text and it's an innocuous text, they mean nothing by it, but it comes across like they're being a real asshole to you because you can't tell tone in the text? Sure. When your slides, your WOW means week over week, but when it's not capital W, little o, capital W, it looks like Jeb's being sarcastic, going minus 0.9%. Wow.
Well, that kind of goes along with the title of this video, that the housing market is selling at a discount, and we'll talk about price reductions here in just a minute. But we got a little sarcasm there in the thumbnail, and some of you guys have noticed that, and we'll talk about what that means here in a moment. So let's look at weekly new listings. So new listings, 71,000 new listings this week. That's 1.5% fewer than a week ago. If you add in the 15,000 sales that immediately happened once they came on the market, that's 86,000 sellers, which is 8% more than just last year. And then that takes us into our week over week changes. So we went from 634 to 645. 645 is now our peak, right? We haven't been above that in the last couple of years. Our low was back in 2022. And then new contracts pending. So new contracts pending, 67,000 new contracts pending for single family homes this week. It's a little bit fewer than last week, or a little bit less than last week, basically unchanged from a year ago. 398,000 single family homes in contract, which is just 3% more than last year at the same time. Median price. So median price is sitting at $455, basically unchanged from last week and last year. Median price of new homes sitting just under $395, which is still 4% higher than last year. And if we measure all the homes in contract, the median price is $399,950, and that's still 4.4% above where we were this time last year. And then price reductions, the big price reduction. So 37.6% of the homes on the market have some sort of price cut, which is the huge discount that we're talking about here. And we're going to talk about more that a little bit more as we dive through the slides. So this looks at yearly average changes for homeowners insurance by insurer. I found this very interesting because, you know, if you're with Farmers, for example, it may be in your best interest to go check with Allstate, with a Travelers, with a State Farm, with another insurer that may not even be listed here, and just see if you can get a discount. Now, I presume that some of this has to do with where you're located in the country. Maybe Farmers is heavily focused on Florida or some of these markets, and that's why the increases are a little bit more. But I just found this a bit interesting because you can see we've had increases annually every year, but 2022 and 2023 for Farmers and Liberty Mutual saw really, really big increases. So, yeah. So, and that came from Resi Club, as you guys can see. So house prices by state, Josh.
That piece will be interesting. What we are starting to see, not directly correlated, but as auto prices, used auto prices, Jeb, as you've pointed out, new auto prices have not come down as much, but as used auto prices have moderated, we're starting to see moderation in auto insurance. So I saw the number this week. Remember, Jeb, during COVID, we were talking about lumber prices. Lumber prices up 1,700% year over year. Lumber prices are right back to where they were pre-COVID. So we've talked on the episode that we did on insurance that loss frequency and loss severity are what dictates what premiums are going to do going forward. But loss severity relates to how much it costs for the materials to put your house back together if you suffer a loss. Hopefully, we're going to see some moderation here as well.
Exactly. So house prices change by state from Q1 of last year to Q1 of this year. Josh, we were talking about this a little bit prior to coming on the show here. What do you want to focus on here? What do you want
just
the viewers
really, you guys probably, if you're not in the Northeast, tired of us being a broken record. The Northeast is leading the country, and that's interesting. Very dense. You know, there's financial centers there, very strong employment, and that often drives home prices. But you see here, that's where we're seeing the biggest increases in home prices. What will be interesting, this is looking backwards at the last 12 months. You talked about Texas and Florida being the epicenter for the increase in inventory, or not just the epicenter, the sole, for the most part, source of these increases of inventory. It'll be interesting that they were up 6.1 and 3.3% over the last 12 months to see what happens going forward. Louisiana was up 2.2. But a lot of these things, like if you look and you hear like, oh, California includes the Bay Area. The Bay Area has had some dips in prices, but statewide we're up 6%. Oregon up 4%. Washington up 5%. So we can either talk about it now or when you want to kind of go through the discount, where we're seeing Redfin's report coming out this week saying that more homes. What was the actual? I remember the headline, Jeb, but what are they actually saying?
You know, that's essentially where the title of this video came from. It had to do with Redfin's article, and essentially it says the typical U.S. home is selling for 0.03% less than list price, with 37.6% of the homes on the market taking a price cut, which is essentially what we just talked about, right? So the typical home is selling for less. What does less mean, right? It's all relative. It depends on where you are in the country, but quote unquote a huge discount it's obviously a play on words, right? It's hyped up for what it is, for the title. But it says that the typical home sold for exactly its list price 1 year ago and roughly 2% above its list price 2 years ago. So, you know, I can put a link to the article in here because I have the article, but more or less homes are stabilizing is more so what I get out of that article than anything else. If you took the nation as a whole and averaged it, but there's still pockets out there, Josh, that are seeing increases, while we're seeing some pockets that are seeing decreases.
Not just geo pockets, Jeb, you talk about on the show all the time. It's price points. In some of these areas, if we're saying, hey, across a state, across a region, that you're seeing a 0.3% dip, where it's probably not happening is in our audience. You guys here, entry-level buyers, that's where we're having the biggest lack of inventory. Jeb's gone through the numbers, mid-price points, especially higher price points. those people have a lot of inventory to pick from, and they're getting bigger discounts. I mean, crazy stuff. This isn't really applicable to anything, but Jeb, poor Justin Timberlake had to take a $1 million price cut on his Tennessee ranch to move that, but it was still twice what he paid for it like 6 years ago.
This is what I can't stand, right? So I saw another article, I forget what celebrity it was, that he had to discount his home $7 million to sell it. And I think, okay, he had to discount it $7 million. The problem with luxury real estate when you start getting into the 10s and 20s and $30 million is nobody really knows what the hell that stuff's worth to start with, right? It's all what somebody's willing to pay. So they took a $7 million price cut to sell it, then it was probably $7 million overpriced, if we're being completely honest, right? It takes a unique buyer for some of this stuff. So it's all relative, but just when you see stuff like that, understand the context behind it, right? It's not, hey, the neighbor's house sold for $7 million more and was exactly the same, and now there's a discount. It's like, no, that's not how this works.
Know that some of these people are unique. Also, you and I, our viewers are like, I want to get a discount. I want the most bitchin' house possible at the lowest price possible. Some of these rich people want to be able to tell their neighbor, well, I paid $1 million more than you did. So weird stuff at those price points, but thought it was an interesting chart, although it doesn't really tell us a whole heck of a lot. This, Jeb, I like for the show here every week that we do the last 5 days in the bond market. And I wanted to chop it up here and show you clearly what happened day by day, because we're going to go through. Last week, we talked about next 5 days, next 7 days is really chock full of data. And the data didn't exactly move the market in the way that we thought. So when we were on air last week, the market had closed last Wednesday at 4.32 on the 10-year. Friday morning, by Friday morning, we got the good PCE data, and we were at 4.26. Well, for some reason, no known market mover. We ran all the way up to 439 by the end of the day. On Monday, we got ISM manufacturing. Again, good data. Good data meaning actually bad news for the economy, but it should have pushed interest rates lower. We're all the way up to 4.49. So again, continued good data the rest of the week. We got reasonable JOLTS data on Tuesday, and today ADP and ISM services, and we're back to 436. So if you look from last Friday when we came on air at 432 to today at 436, 0.04, you're like, oh, the market didn't move. Well, we had lots of movement, and it didn't necessarily follow what happened. So let's look. Friday, we talked about the PCE being good, 2.6 headline and core year over year. The month over month numbers were good. We're going to look kind of at the look forward. We've talked about this base year effects and being able to kind of reverse engineer this number. So I got a couple slides in here on that. The comparisons are going to get more difficult going forward, but this was a really good number. Everyone should have looked at this and gone, oh, hey, great. But yet rates got worse on Friday, and worse all the way into the close. Usually we get most of the market activity in the morning and then just kind of peters out and flatlines into the end of the day. We had selling all the way into the very end of the day. Not very many satisfying explanations for what happened. We have European yields moving higher with sort of the chaos with the politics in France and the EU. We have Japan, their yields are going higher. So Asian governments and investors are able to keep some of their money closer to home. Maybe that's limiting bond buying here in the US. And then, of course, Jeb, last week we had the wonderful debate, and there is great fear that our president did so poorly in that debate that every Republican in the world is going to get elected, and they're all going to have control of the House, the Senate, and the White House. It's a theory. It's a theory. So Monday we come in, we talk about ISM manufacturing. We saw from basically early 2021 dip all the way through 2023. And then sort of this, I think this is going to end up being a head fake, but those numbers had picked up. And over the last few months, ISM manufacturing down. So the forecast was 49.2. We came in at 48.5, which was lower than the previous at 48.7. That should have improved rates. But again, we saw continued selling. Yesterday, what we had was JOLTS. It's a job opening and labor turnover survey. And paradoxically, we want to see less job openings, because when there's a lot of job openings and few workers to fill them, employers have to pay more. So you get bigger wage gains, which everyone goes, hey, that's crazy. I want wage gains. I want workers to make a lot of money. That is one of the greatest predictors of inflation. So I like this chart. It overlays it with Indeed job postings index. That's real, actual data that they pull, and it tracks very closely to JOLTS. So we saw a little bit of an uptick there in JOLTS job openings. The market pretty much shook it off, as they should, because once you dive into the components, Jeb, almost all of the additional job openings were in government jobs. So I don't know why our government is running around thinking they need more employees when the public sector is shedding job openings, but they did. So we did actually see some improvement on Tuesday. Today, this morning, we got ADP. Again, we don't want to see job losses. We're still well positive, 150,000. So we were forecast at 163. It came in at 150. Last month was at 157. So a decrease from last month, a decrease from projections, and well below where we were at through 22 and 23. Again, less wage pressure upwards. And I meant to put the numbers in here, Jeb. We actually saw a decrease in year-over-year wage increases for both job leavers and job stayers, which well above the long-term trend. So people are still getting bigger raises than they have historically, but not nearly as much that they had in the past. This was where the market really picked up today. ISM services was forecast at 52.6, came in at 48.8. Previous month was 53.8. Anything under 50 is contraction. So it's telling you the services segment of the economy is contracting. That's been the hottest segment of the economy, driving a lot of inflation. The market liked this. So this one we had yesterday, Jeb. Austin Goolsbee is the president of the Federal Reserve Bank of Chicago. Not a voting member this year, but through some quirks of a voting member leaving and not getting replaced for a month, he will vote at the next meeting in July. He says, we got to this rate when inflation was over 4%, and inflation is now down close to 2.5%. So if you sit with this rate somewhere while inflation goes down, you're tightening. So basically, we talked about this very early in the year, Jeb, after one of the Fed meetings. It's like the February meeting. They're saying, oh, we still need to remain tight. Well, as inflation comes down, if you don't loosen, you are, in fact, tightening. So what he's saying is the reason that you would want to tighten is if you think that you're not on a path to 2%. So the quote goes on longer. We got a lot of Fed speakers out this week saying the same thing, that they're not comfortable or confident that we're at 2%, but all of the data, which we're seeing here, at least over the last week, has moved in the right direction. So this chart, Jeb, was interesting. Beginning next month in June, we're going to see base effects mechanically raise year-on-year PCE inflation in June, July, and August. That's because a year-over-year read is essentially a 12-month moving average of the monthly reads. Over the next 3 months, low reads from last year will fall out. What's funny is he shows an annualized chart, which doesn't really make his point. But if we look here at the month over month, next month, we do have a big number of 0.3 falling off, but then 2 months after that, 0.2, 0.2, and then 4 out of the next 5 months are 0.1s. So even if we get a wonderful month over month 0.1 reading, which tells us we're on an annualized pace of 1.2% core PCE, we're not going to improve, because we're basically a 0.1 falls off, a 0.1 comes on. So for the next 6 to 7 months, the year-over-year readings are not going to improve. And the important thing we're going to want to look at is month to month, are we up at 0 month over month, 0.1, 0.2, worst case? If we get these spikes to 0.3, 0.4, 0.5, it will be bad. On that topic, the Cleveland Fed does their inflation nowcast. If you look at it here, they are showing it continuing to moderate for PCE 2.48 and 2.61. So trueflation, we've talked about this, Jeb, a lot of noise in this in terms of it drops and then it spikes and then it drops and then it spikes. But if you look at that trend from September of last year through now, the trend is absolutely downwards. And the difference between this and CPI and PCE is it is a more current look primarily at housing, whether it's owner's equivalent rents, whatever measure, this is bringing that in more real time. This one gets a lot of publicity, Jeb. People say the Atlanta Fed doesn't know what they're doing. They were up over 4%, and now a couple weeks later, they're down under 2%. This is a nowcast that gets updated throughout the quarter. At the beginning of the quarter, the data often comes out higher, hotter, and gets revised down. So we're always going to see that green line trending down. But we are looking at an economy that is probably at about where they're projecting right now, 1.5% GDP annualized growth, which we were at 4.0% unemployment rate, and we're going to get that look on Friday. Maybe it goes to 4.1, 4.2. Still a historically tight labor market, still a growing economy. All things are positive, just not as positive as they were, which was leading to a lot of that inflation. What does that tell us? It says that the Fed is now 78% odds of a September cut before the election, and then another 87% odds of a December cut. that. So the market is heavily back in favor of 2 cuts this year. The data is going to dictate that. Thought this was interesting, Jeb, yields versus the first cut. The timing of the first rate cut has historically been important for the bond market, as yields tend to peak 2 to 3 months before the first rate cut. Well, we hit 5%. Was it November of last year, Jeb? So we're well past that 2 to 3 months. It is likely that we will see cuts very soon because that peak was quite some time ago. And even if we say, I think April was when we sort of revisited those highs at 4.7, 4.8, we are due for a cut. Here's our wonderful chart that we're looking at. Unfortunately, this plays out very, very often. That green downtrend that we are in now, you see you run up to the top and then down to the bottom. When we hit the bottom, it is more likely that we stay in that range and move our way up to the top. What we're looking for is a lower high than the last time, and I think we barely maintained that. We're now back inside the range. If we get good inflation data or a good jobs report, meaning slightly higher unemployment rate, very likely that we run to the bottom of this channel, and that's a downtrending channel, so it will be lower than the last time. So we want to look at breaking through that 421 at some point, and then 407 is probably going to be some significant resistance. But when you say we're at 435 today, a run to 42 is a quarter or an eighth lower in rates. A run all the way to 407 is 3/8 better in interest rates. So as we saw over the last month, we don't have any guarantees, despite what the data says, how the market's going to react. But the trend and expectations should be in our favor. What does that mean for interest rates? This chart, Jeb, I could have just copied the one from last week and the week before that and the week before that. 708 on the 30-year fixed, FHA, VA at 6.5. Again, those are a little bit high. This takes into account all interest rates, all credit scores, down payments, all that fun stuff. Most of my standard balance conventional loans are under 7% right now, with the high balance a little different. And most of the FHA and VA is that 6.25 range. So that's all we got, Jeb.
Right, Josh, are you tired of talking? You talked for like 10 minutes there. 10 minutes straight.
I'm gonna rest. Now it's your time to answer questions.
Well, let's do this. Let's start with a couple of comments. Your keys to Daytona Beach. I'm assuming real estate agents. Love y'all's comment. Thank you for watching. We got Marcus saying that video on the loan estimate was very informative. Thank you for the great videos. But why do lender rates vary so much, Josh? So a comment. So thank you for the comment, first off. And why do you have varying rates from one lender to another, Josh? I can understand bank to broker to credit union, different types of entities, if you will. But why do two brokers vary? I guess is a better question.
Margin. Some people in the business feel like I'm a great salesperson. I can sell you on a higher interest rate and tell you I'm awesome. So on the broker side, really the maximum you can make is 2.75 points. And I know brokers that's what I make, 2.75 every deal. That's what it is. And for us in Southern California, market's really competitive. It's very hard to get anything over 2 just because loan sizes are bigger, lots of loan officers. So some of it can be where you're located. If you're buying leads, if you're a mortgage person buying leads, the cost of the leads tells you how competitive your market is. Southern California, very expensive. Texas, expensive. Florida, expensive. Lots of buyers and borrowers there, lots of originators trying to sell loans to them. So if you're in an area that has less competition, if you have less broker penetration, Jeb talked about the difference between different channels. If you are a big national lender and you either are running 2, 3, 4 big nationwide call centers and running Super Bowl ads, that's very expensive. If you have 50 offices around the country that 20 loan officers work out of, and they're in Class A buildings, that's very expensive. What I would say to this, and Jeb, you can comment on this. You were in the mortgage business back in the day, like pre-internet, the ranges that we see. When I tell you guys, like, it's pretty hard to get screwed hard on a mortgage. You can be on the high end of that range, but that range is pretty narrow. If you go back in the day, I would have people come to me, like we did that episode, Jeb, on the loan estimate. I would have people back in the good faith estimate days say, oh, this guy gave me a good faith estimate and it's way better than yours. Lower fees, lower rate, everything. People would call me 2 days before closing in tears. Like, I just signed my loan docs. It's a 0.5% higher and I'm paying $10,000. people would make 4, 5, 6 points on a deal. That was not uncommon. That is not possible in today's market. So it wasn't necessarily your question, but the range today is pretty darn narrow relative to what it has been historically, but really just different people's expectations of what they think their time is worth. And paradoxically, some of the people that only do 1 or 2 loans a month think that, well, I only do 2 deals a month, I got to make 3 points on them.
All right. Willing says, how does a borrower handle an earnest money deposit if they are doing 100% financing? Do they have to come out of pocket and then get reimbursed? Essentially, yes. If you're doing 100% financing, say you're a VA borrower, you're buying 100%, you still need money for an EMD, for an earnest money deposit, because essentially that's what binds the contract. Now, it doesn't have to be a specific amount. I think it could probably be $1, depending on what the buyer and the seller agree on. But as somebody that lists properties, right? I help borrowers, buyers and sellers. But if somebody comes in with a small deposit, one of the things that I talk about to the seller is, hey, listen, if we go through the contract with this buyer and we waste 15, 20 days and they decide not to move forward, that deposit essentially is somewhat of your, the reason to go through the process with these people, right? It's if they back out, it's your way to recoup some of that time. And so if somebody's only willing to offer $1 or $100 or $500 or whatever, as a seller, not really worth the time unless you have certainty that that borrower is moving forward. And there's no certainty in this business. So, to get back to your question, would they have to come up with an earnest money deposit? Yeah, probably. It doesn't have to be 3%. Maybe it's $1,000 or whatever they can agree on. But if they're getting 100% financing, the closing costs are being covered, then essentially they would get that deposit back at the close of escrow. But understand, they can't get more out of the deal than they put in. So if they put $1,000 in, they can't get $2,000 back at the close of escrow. The most they can get back is $1,000. So hopefully that's helpful.
And I was going to say the same thing. That really is a realtor question, because from a lender's perspective, I don't care. I don't have to have a deposit. It really is between the agents and the buyer and seller that they're representing. From the lender's perspective, there is no requirement for a deposit. That requirement is exactly what Jeb said it is.
All right, good stuff. Another one from Willing, really quick, easy. Does FHA require all borrowers to occupy the property? Yes. As a primary residence when you've purchased the home. You can turn it into a rental at some point in the future, but in buying it, it has to be a rental unless it's units, in which point you can have, part of them be investment, but you still have to live in one.
The question behind the question there, can you have a non-occupying co-borrower? You absolutely can. So yes, you can have a borrower on the loan. All buyers have to occupy. All borrowers do not have to occupy.
All right. Good stuff. Mina, again, weekly $5 super chat. Thank you for that, Mina. Nice beard cut. Thank you. I appreciate it. Should we expect any movement in mortgage rates lower if the Fed decides to cut rates in September? 60% chance they will cut. So high likelihood they will cut. I think Josh just showed the chart of 70-something%. They were going to cut in September.
It was 60. She was right. It was like 60 yesterday, and then today it jumped.
Yeah. So big, or more of a likelihood that they're going to cut in September. Should that lower rates? I would think that would help the spreads out, and rates should follow down a little bit. But just because they cut a quarter doesn't mean rates fall a quarter, right? I think part of this expectation is built into the market to some degree. But once you get confirmation that it's actually going to happen, I think you get some follow through on that, and rates do move lower. But we got some time. We got some time and a lot of data between now and then for a little bit more confirmation.
Think about this, Jeb. The market absolutely front runs the Fed. They don't wait for the Fed confirmation, but we're kind of in a unique position right now because so many head fakes. Like, what have we been thinking for the better part of 12, 18 months? That first Fed cut is coming. I think the first one sort of breaks the seal. Until we see an actual Fed cut, the market's kind of gun shy. They've jumped the gun too many times expecting a cut to come, that I think we will see some relief. Normally you see the movement ahead of the first Fed cut. I think we're going to see more after the first Fed cut because of people being gun shy.
Yeah. And the politics are playing a part in this whole deal. So, you do have, I said a couple of weeks ago, luxury real estate, a lot of money tied up into assets, a lot of money in different places. Politics play a decision in how these people proceed at this point, depending on who gets in, decides whether or not they buy now or buy then, or maybe even wait a little bit. So it'll be interesting.
Jeb, it will be very interesting. And we try to be as apolitical as possible. For the context of home ownership and your finances, I don't care. I don't care who's in the office. But it's funny, historically, government Democrats have been considered tax and spend. So that's bad for inflation, bad for the economy. The market is fairly convinced, based off of 4 years we've already had with Trump, that Trump will be more inflationary than Biden. And all of
that's one reason we've seen the rates do what they have.
Yeah,
and you kind of mentioned that at the beginning, but didn't say that, and that's really it. They believe if Trump gets in office, it's a higher likelihood there's more spending going to happen, which in turn is going to lead to inflation, which in turn leads to other problems.
And I don't even know.
We don't know. Right. So
we don't know. And we don't even know that it's so much in terms of spending, but we saw he cut taxes the first time. He's a businessman. He loves, stimulus in the form of lower taxes. And we're at the point, I like it, but we're at the point where we can't afford it. We can't afford it. Our government can't afford anything, and they got to figure it out.
All right. Good stuff. Let's see here. What do we got? Ozzy mentioned earlier, lives in SoCal. No houses are declining in price. And even if people keep saying that there is a California exodus, prices are just increasing and inventory is low. So, yes, I mean, Ozzy, essentially what you're saying is what I've been saying the last couple of years. Yes, there are people leaving, but the net migration or net immigration, migration, I guess it is relatively low when you look at it, right? We got a lot of people leaving, but a lot of people coming in, and therefore, it's less of a problem. But inventory is what drives markets. It's not how many people are leaving or coming in a state. It really comes down to inventory. And as long as you have less supply than you have buyer demand, you're going to have a market very similar to the one that we've seen. But I will say the market is slowing down. It has slowed down. It is slowing down. Even here in Orange County, inventory is increasing. It's not crazy, but we definitely have a slower market. And it is time of the year. Definitely seasonality is playing a part in that. Affordability is playing a part in that. And I think, just the waiting game of what's going to happen is also playing a part of that. And so all of those things combined, it's going to be another, super low year of home sales. Like we talked in the forecast, Josh, everybody's predicting 4.7, 4.8. I'm thinking, no way. You can't see that kind of jump without seeing a huge increase in inventory and lower rates. And because of that, we're going to see another kind of a dull year when it comes to number of transactions. Yeah. Let's see here. Question from Maddie says, are you seeing overpriced listings being pulled from the market after a few weeks rather than lower the price? Sometimes even relisted a month later at a higher price. I'm near Sacramento. No, overpriced listings aren't necessarily being pulled from the market. Typically what happens is all listings, you have to have a listing agreement, a time frame in that contract. I, as a real estate agent in the market that we've been in, like to do 6-month listing agreements, and during the height of the pandemic, I was even okay with a 90-day listing agreement just because the market was moving so fast that I didn't feel like I needed much longer than that. Now, when the market was slow back in 2010, 2011, we would do a year listing agreements and even then have to extend them because things weren't selling quickly enough. So, if a home's on the market for less than 60 days, you haven't really tested the market out. I mean, yes, everybody has really short-term memory that, and they believe that everything should sell the next day, it should sell in a week. And if it's been on the market for 2 weeks and it hasn't sold, then it's overpriced. That's not the market. You got to factor in all these changes, everything happening, and then see what the market's doing. But I would say the majority of people reduce the price to some degree, and then kind of test the market. If you have somebody not willing to reduce, they just want to pull it off the market, then they're not a real seller. And that's one of the things as an agent, you want to confirm before you even go through the process. Like, hey, what's the motivation? Why are you doing this? And talk through what it looks like if you don't get your price, and so that there's some expectation. So hopefully that's helpful. With that, Maddie commented on my shirt. He said, I jumped to real and all I got was the shirt. So, you got
like seven of them, one for every day of the week.
I actually got more than that. I've capped for the year. I have to pay them no more commissions. It was the greatest deal ever. In a month, I capped with them, paid no more commissions, and it's fantastic. So it was a smart move. I should have done it years ago, if I'm being completely honest. And Maddie, I know you're a real estate agent. You should come join me. But no, in all reality, it was a really, really good move. I'm glad I did it. Let's see here. Josh, do national banks tend to have more conditions than brokers for the same type of loan?
I wouldn't necessarily say so. You start to know. So what would I know? I would know the wholesale lenders that we work with, which is a lot of them. And I know there are certain lenders that are going to over condition and certain lenders that are going to let things slide that they probably shouldn't. But if it's a lender that I don't work with, it's a retail lender, a big national retail lender, or a bank that we don't do wholesale deals with, you would never know. But absolutely, it's going to be the same. But I don't think it's necessarily per channel. It's just per different investors. Jeb and I have friends. A good buddy that Jeb used to be a member with over at Seacliff here is a big bank. And he's like, we have the most amazing rates in the history of the world. They want you to move $1 million over here to the account, and they're going to take 60 days to underwrite your loan. But the terms are awesome. So you get to know sort of the unique little niches of what everyone and everything will do. Pros and cons to everything. You're not going to find some place that's going to make it super easy, low conditions, low fees, low interest rates, quick close. Like you got to kind of have a trade-off in terms of everything.
Good stuff. Bits of Interest said Jeb looks less butt face and more butt rock this week. I don't know what butt rock is. I know what a butt.
I haven't seen his butt rock yet, but we'll maybe tomorrow.
What is a butt rock?
I don't know. I'm
don't know
lost.
what that is. I know what a butt face is. I think running around the house.
I think Bits of Interest has already started the Coors Light a little early for 4th of July.
You know, well then they're just hydrating. They're just hydrating for the real stuff tomorrow.
Yeah.
Let's see here. Willing's coming in with all the comments tonight. So Willing says, is it better to pay a mortgage off or keep mortgage and invest the money? Ramsey advice seemed a bit spiteful. So here's the deal. We actually recorded an episode today where we talk about velocity banking. Do you know what velocity banking is? Most people, I would say, probably have no idea when you say that. But it's this whole idea that you can pay your mortgage off in 7 years, 8 years, 9 years.
It's magic.
By taking a home equity line of credit and using that to help facilitate and blah, blah, blah. So we go through the entire video. We go through the numbers. We help you make sense of it. So if you're interested in paying off your mortgage quicker, you should check out that video because we talk about it. But to go back to your question, is it better to pay off the mortgage? It depends on what your goals are. Willing, some people don't want mortgage debt. Others, have a 2.5% interest rate and like, who cares? This is free money. I'm earning 7% over here and my mortgage is 2.5%. I don't care what my mortgage is. I'm not paying that thing off. I'd rather invest my money. So I think it all comes down to goals. Dave is very, very, what's the right word, Josh?
It's beyond concern. It's beyond conservative.
With his recommendations, and it is all about being in cash and not having any debt and all of that stuff, which is fantastic. But I will say there's a lot of people out there that have debt and have done very well financially, and you don't have to be Dave Ramsey to get that. So.
Jeb, let's take this from a different angle because we answered this question about 900 times when rates were 2.5%, 3%, and it was an easy one. If you are comfortable investing, and even if you think you're going to fail miserably, you're not going to get the 8% long run or return on your money, you're going to get 5%. If you're borrowing at 2.5%, 3.5%, why would you ever pay that off? Now we're in a different world. If your mortgage rate is 6.5%, 7.5%, 7.5%, and maybe you're not a super confident investor and you're worried that you're not going to get 8%, or you end up in a 10-year period where the market returns 5%, it's probably a more reasonable decision to prepay your mortgage now than it has been previously. But the biggest downside to me in terms of doing that is loss of liquidity. It is trapped back in that house. The only way you are getting that money back is going and asking someone for permission to get it and paying them for the right to do so in the form of a refinance. So I'm not saying it's a bad idea to prepay your mortgage. I'm just saying always be very careful and deliberate. And for me, personal preference would be to have an offset account where I am saving that additional money and investing it and growing it faster. In that episode today, Jeb, we ran the numbers for $400,000 mortgage at 6.5%. I think it was $250 extra, $400, something like that, to pay it off in 20 years. Well, if you took that $400 and invested it, got an 8% return, you end up about $60,000 ahead in 20 years, or you could pay that house off in like 16 13.5 years.
Yep.
So multiple ways to look at it. It's going to come down to your risk tolerance and your comfort level of investing.
All right, good stuff. If you haven't done so already, find any value at all, we answered your question. Do us a favor and hit the thumbs up. And if you haven't done so, subscribe to the channel. It helps us out. I know a lot of you guys are out there shopping for mortgages and trying to figure out your rates and what the best rate is. And, am I approved? There's a referral link. Scroll in the bottom now if you want to get in touch with Josh, the team here. Josh just popped a drink open, by the way, in the middle of that. Josh, show them the drink. Show them what you're drinking over there. But anyway, if we could be of any assistance to you, there's a referral link there. Reach out, and we'd be happy to.
Are you looking for another sponsor? Are you looking for anher sponsor, Jeb?
That's actually
these guys.
No, I'm not a vodka drinker. No, I'm not. But June Shine, if they have something that's not vodka, perhaps
their,
yes.
their ranch water is the best. So if they could send us like 17 cases of ranch water, that would be ideal.
There you go. Josh is stressed out. He's stressed in this business, and he's looking for something to take the edge off. Let's see. Dina,
I'm celebrating the birth of our country, Jeb.
Fantastic. That's good. Dina says, just grateful for you guys. You both take so much time to keep everyone informed, and you guys are honest. Hard to find today. So thank you. Yes, we are honest, and we appreciate you recognizing that and being here as always. It's very, very appreciative, and we're grateful for that. Willie says, have you ever drank a CO2 coconut water? Ordered a case today. Yes, I hate coconut water. It is awful.
No, bad. Some of them are bad. Some of them are good.
No,
you got the wrong one. I'm gonna bring one to your house tomorrow. The good one.
I drank the one. What's the one that at Itzler sold, that company?
Zyko.
Yeah, awful.
Zyko's awful. Undrinkable. Yeah. Taste Nirvana is the one that you want. It is magic.
Yeah, I don't know, but anyway, but you might need to send that case back, Will, and just saying. Crypto Sapito. How long should a home be on the market before you hit them with a lowball offer? Depends on your strategy, how much overpriced, what's a lowball offer, right? I think everyball wants to do a lowball offer. I haven't seen a lowball, quote unquote, lowball offer accepted in a very long time. Lowball offers in competitive markets typically don't happen on market. If the lowball market, if you will, are for distressed sales outside of escrow, the homes that never see the market, the homes that don't get the demand. And those happen on the wholesale side. They happen, people, looking for distress and needing cash immediately and that sort of thing. But I don't know. I would say in this environment, a home that's been you got to find a motivated seller that has to sell. And I guess time is dependent. I don't know what a time would be in this market. It would have to be a long time because it's still very competitive out there. So
it's very competitive here. Let's use an example. We got a list.
If the home is priced right, so if it's overpriced, then it's a whole different deal. But anyway.
Well, Jeb, let's look at this. We have a listener to the show that he's already under contract. The property had been on the market. The property got a price cut. The seller is a veteran getting moved overseas, so highly motivated, needs to sell, needs to get this off the books. We had a bad plumbing inspection, and we had a low appraisal because it's kind of not rural, but it's in an area where there's just not a lot of comps. I don't necessarily think he's overpaying for it. I don't think he's overpaying for it at all. Just very difficult to comp and appraise. And so you would think someone highly motivated to sell, that we have kind of set what the value is. They did have a couple of different offers on the property, but the agent knew going in it was going to be an appraisal issue. And even that person who's highly motivated to sell and has a tight time frame, they're pushing back really hard on coming down off that price very much. And I think that's pretty typical with what we're seeing right now.
No, for example, like I had a property here in Huntington Beach. 56 days. It was on the market 56 days before we went into escrow. And it was a $510,000 property, single family, condo, 1 bedroom, sited to a street. So less than ideal in a number of ways. 1 bedroom, obviously less people looking at it, sides to a street, less people looking at it, senior community, less people looking at it. So you factor all these things in, right? So we priced it at 510. We ended up still selling it for $500,000. 500,000 after 56 days. So for some people, they look at the market and go, 56 days, that's an eternity. That is so long. Is it? I mean, the average days on market here in Orange County is like 40 something days, so, and that's because some homes sell in 1 day, some homes sell in, 100 days. And so the average, right, is that somewhere in the middle. So you got to figure out what goals are. You got to figure out if you're priced right. We received some lowball offers in that deal. And lowball in the sense that it was 40,000 or something less than the asking price. So almost 10%.
That's a lot.
And you would think, oh, he better take that. No, we knew where we priced it. I knew what I was doing. We ended up getting our number. That's simple. So you need to have a professional on your side and know what you're willing to do and what you're not willing to do.
Jeb, along the same subject line, budget with twins. When agents list motivated seller, is that a gimmick?
No, not necessarily. Another property just put into contract, same community, senior community. It was listed at 625. My conversation with the agent, she tells me seller's motivated. Okay, it had only been on the market like 10 days. Seller's motivated. What does that mean? I don't know. So we put in an offer at 610 because the comp supported 625. So it was priced right. But we put in a lower offer because she's a motivated seller. Fantastic. Let's go $15,000 under and see what happens. They accepted it. Well, guess what also happened? Well, also, there was a list of repairs that needed to be done. And we asked for $8,000 towards repairs. Why? Motivated seller. Hey, why not? Let's see what happens. Guess what? They accepted it. So we ended up getting the property for 602. And, you could say deal, no deal, whatever, but the comp supports 625. There was one that sold at 650 not that long ago. So 625 was reasonable. I don't know. So in some cases, motivated seller means something. But as an agent, you're doing your client a disservice, if I'm being honest, by putting motivated seller anywhere, right? Because that hurts your ability to negotiate. I mean, that's just me. So I'm not putting that anywhere unless the client tells me to put, hey, I'm motivated. Okay, then we'll do that. But you stay away from that. All right. Josh, you got someone asking to see Peanut.
I like that. Peanut is much better behaved. She got to go to sleepaway camp and she came home well. I wouldn't say well behaved. She's always well behaved with us. She's a little wild around other people, but Peanut's mom and her are like Velcro, like attached at the hip. So I rarely get to bring her to the office on Wednesdays when we're doing the show, unless mom's out of town.
There you go. Let's see here. Budget with Twins says, I'm seeing huge price reductions in houses in my area, 30 minutes south of Portland, but interest rates are still high, making home affordability still high. Is it smarter to continue to be patient? I think patience is always the right answer. But you got to find, can you find the right house at a payment you're comfortable with right now? If the answer is yes, then I don't know if waiting is the right answer. What are you waiting for, right? That's always the question. What are you waiting for? Are you waiting for the prices to even go lower? Are you waiting for rates to go lower? Are you waiting for both to happen at the same time, which that typically doesn't work? You got to figure out your motivations. If you buy at a price you're comfortable with a little bit higher rate, there's an opportunity in the future if rates do go down, or when they do go down, assuming you can still qualify, you could lower that rate, right? But you get the property now at the value now, and don't have to risk prices going up if more demand comes to the market. So it's kind of a catch-22. You've got to decide what's right for you, what you're comfortable with, and then make your decision based on that. Josh, let's see here. We always have this question. I'm gonna save it for the end because it deals with rates. So no, if you're still here, know that your question is going to be answered, but we're going to talk about rate locking at the end, because we always talk about it and people have multiple questions about locking now versus waiting. So we'll just hold off and do that then. Willing rather says, if a seller is going to put a new roof on a home, does that count in the seller contribution percent, or will the borrower still get 3% seller contributions plus the new roof? So it depends, right? So if I negotiated part of the contract and I said buyer or seller to pay buyer 3% towards closing costs, right? That was our agreement. And they signed that. And then we get under contract and we decide we do the inspection and we figure out the roof's bad and we say, you know what, we'd like the seller to replace it. We do a repair request and we ask the seller to replace the roof and they agree to it. That's two separate things. You still get the 3%. You still get the contribution for the roof, right? Those do not go hand in hand. The only time one would take from another unless it's explicitly explained, like the 3% I'm contributing to you includes this new roof, which took out, 20,000 of the 30,000 I was going to get. Like, it needs to be laid out explicitly so that there's no confusion in that. But I would say, typically speaking, the two are different.
From the loan guideline perspective, Jeb, the important part is that if you're going to do the roof, so let's say that with your program, FHA will allow you to go up to 6%, but the minimum down conventional 3% is the max you can get. Jeb and his seller agree to give you 3%. Now you find out it needs a new roof. If you put it on the buyer side of the settlement statement with a credit from the seller, that is an interested party contribution. If the roof gets put on, the invoice gets provided to escrow, and it goes on the buyer side and the seller side, and the seller pays for the roof, doesn't impact our side of the transaction. So it is important how you structure it. So work with your mortgage professional, work with your real estate professional, and get it done properly.
All right, good stuff. Question from Jennifer says, how does an appraiser figure out the amount the home is worth if only 2 condos in the area within 5 miles is on the market, and it's been almost 1 year since 2 of the condos in my community sold? So they would have to, it depends, right? They have a number of ways they could do it. If they can't go outside of the area, right, and still stay close by and find comparable properties, they can go back to the 2 that sold, a year ago and factor in appreciation and do some other things in order to bring those up to current value. It makes it a lot easier, right? When you have recent sales, when you have comparable homes in a community, that all helps, but doesn't always work out, especially in some rural areas. So appraisers just have to go a little bit further out and do some different things in order to make that happen. And sometimes you maybe if you have a 2-bedroom, they can take a 3-bedroom, right? Not necessarily the same property, and factor in that bedroom, right? Or take away for that bedroom on the 3-bedroom, or if it's a 1-bedroom, they can add to it. All of those different things in order to make the numbers make sense. So hopefully that helps. Josh, we got 007 reached an 850 credit score, they say. Josh, is there a prize reserved for the perfect credit score?
There is no prize. It used to be anything over 740 for conventional was treated as the best tier. Jumbo, you can get some advantages getting up to 800 and above. Really, the only advantage is the automated underwriting system is going to look at that very favorably. It's going to say this person is able to manage credit, and whatever the maximum debt to income ratio is available, whatever the most aggressive approval would be, you would get that. But nothing specific other than it does feel nice. I think I've told you, Jeb, I've watched mine. I watch mine with Experian, and Experian kind of shows as you do different stuff. And anytime I do something where I run up a credit card or buy something, it causes that score to deviate. I don't like it. So just enjoy the feeling of having the 850 credit score.
Here's the deal. Like a lot of things in life, Josh, I don't pay attention to it at all. I just make sure I pay my bills on time. I don't have a lot of debt. And I get surprised every single time my credit gets run, which is not very often, but every couple of years for one reason or another. And it's like, hey, where is it today? Oh, it's 780, or maybe it's 770 or whatever, whatever the number is. Like, oh, okay, who cares? I don't know, But anyway, that's just me. Crypto has another question. It says, is price per square foot a good parameter to use to see if a home is overpriced? No, it can be, but I would say, typically speaking, I don't pay attention to price per square foot. And the reason for that, I will take my neighborhood, for example. My neighborhood, you have single level homes.
Yours isn't a good example, Jeb.
It's a fantastic example because you look at my home consists of single story homes and 2-story homes. And the single story homes sell at a premium, less square footage, and the price per square foot is insane, right? So you'll have let's say a 1,300 square foot home in my community could sell for $1.3 million. So $1,000 a square foot, essentially. But you could have a property that is 2,200 square feet sell for 1.4, 1.5, which whatever the math is on that is not $1,000 a square foot. And you would go, well, the single level is clearly overpriced. It's 1,000. No, not how it works. There's different reasons it sells for a higher premium when it comes to price. So you can't compare those two. But when it does work out is when you have a model match, a very comparable property in a neighborhood that has similar upgrades, similar lot size, similar, ideally same property, located on the same side of the street, same view, all of that stuff. And you can say, well, this one sold for $750 a square foot a couple weeks ago. Pretty close to $750 a square foot, or whatever the number is. That's when I kind of use those numbers, but I don't look at price per square foot for that reason. I go out and try to find comparable homes, work backwards. And then if I get completely stuck and I'm like, I don't know where the value is, then I'll start looking at price per square foot a little bit, but I don't use it for, say, taking that number, multiplying it by it and saying, hey, this is the price. I do it to get an idea, but I know some agents do pay attention to it a little bit more. But what are your thoughts on it, Josh? You said mine wasn't a good example.
Yours, it's kind of like mine. You showed me the little one in your neighborhood. That price per square foot is going to be huge. Does that mean there's my lights, Jeb?
Yes.
I got it for you.
I win again.
We're 55 minutes in. I didn't want you disappointed. So we got those lights on. But your neighborhood and mine are both similar in that there is a very desirable small a home in there. Mine's the little one, single story, 3-car garage. That one in your neighborhood, single story, super desirable near the beach. And that price per square foot looks ridiculous relative to everything else in there. And then in yours and mine, older community, right? So you can have a shitty house come on the market, settle a low price per square foot, and then one just sold my neighborhood for $2.7 million. You can't look at that and go, oh, my house is worth $2.7 million. Someone completely rebuilt the house last year and added 600 square feet. So it's probably not the best example in terms of price per square foot. So big picture for me, it's a quick and dirty number to start with. But then if something is way out of the norm for the neighborhood, now you start going, why? Is it reasonable, or do we have a crazy seller?
No, absolutely. The answer is always a crazy seller. Let's go. Nose question. New construction home projected to be completed mid-September. Sorry. When would you recommend locking an interest rate, Josh? So mid-September is August, September. We're 60, 70 days away. 70 days away.
So a couple things come into play. Anything longer than a 30-day lock is going to worsen your pricing. So 45 days, 60 days, 90 days gets a little bit worse. So if we think rates are going to stay the same, you'd like to get within 30-day window. If you think rates are going to get worse, then you might be willing to pay that insurance to not have to deal with it. If we think rates are going to get better, then we absolutely want to get within that 30-day window. So we show here every week that downtrend channel, and you can see week over week, we can go from the bottom to the top of that channel. So the downtrend does not tell us that week over week, day over day, rates are going to get better. It tells us that they are moving better in an up and down manner. So as long as we're in that down channel, I would hold off. Does that mean that it's the right answer for you? Jeb, we had Matt Graham on in the fall as a guest. He wrote an awesome article on lock float decision. And bottom line, too long didn't read. For 90% of people, just lock the loan. You're in a unique position in that I feel pretty strongly that rates are going to continue coming down or at least stay flat. And that is a long window, plus 60 days to bite off paying an extra quarter to a half point just to get that level of insurance that shouldn't be necessary.
All right, good stuff. Pros, cons says worth it to buy down the rate right now, Josh. Would you buy down a rate with the market that we see right now?
I wouldn't. It doesn't mean that it's wrong. A permanent buy down is a sunk cost. If you buy your rate down, you pay 2 points and get the rate down 0.5%, and the rates move down 1% in a year, and you refinance to get that additional 0.5%, then the 2 points that you paid is gone. It's not cost. You never get it back. A temporary buy down, can you justify it? Yeah. To me, a temporary buy down is smoke and mirrors. If you have the 1.8, 1.9 points to pay for a 2-1 buy down, put the money in the bank and subsidize the monthly payment yourself versus setting up that buy down impound account with the lender to do it for you. Doesn't mean I'm right. It's just my perspective on it, and make sure that it's not, I hear a lot of loan officers that love this and think this is awesome. And it's almost a sales tactic. Well, listen, this magic, we're doing this. There's no magic. It's all just math. Your debits and credits, you're moving money from one column to the other. So whatever feels right to you, as long as it's been explained properly and you understand the decision you're making.
A lot like the episode we filmed today, Josh, on velocity banking. You know, how do you pay your mortgage off quicker? You pay more money towards your mortgage is the easy answer. How do you get your rate lower? You pay money to buy it down. Well, guess what? It's the same money that you'd be paying towards the payment every month.
Yep.
To some degree, right? So
yep.
each his own. You got to do what's best for you. But with that, you know, talk to somebody. Get comparisons. Ask why somebody thinks you should buy down the rate. Like Josh, compare, contrast different programs. Why buy down? Maybe reduce the price, right? If you think rates are moving lower now, get that money that the seller is willing to give you and pay less on the home, and then be able to refinance it down the road when rates actually move down. That way it's a win-win, because you're getting the home at a cheaper or less expensive price. But with that, guys, we've been on an hour. Not a lot of questions here. I know it's the 4th, so I want to appreciate or say thank you guys for joining us. We appreciate it. We appreciate you being here. As always, if you haven't done so already, hit the thumbs up. Check out the podcast. If Josh and I can be of assistance to you, there's a referral link below. Josh, any parting wisdom for those on the eve of 4th of July, outside of don't blow off your hand with fireworks?
Come back with all of your fingers next week. So be here so you can control your mouse and keyboard and join us again next week. That is rule number 1. Rule number 2, if something doesn't sound right, or if it doesn't feel right, it just it's frustrating from this end. A lot of times we talk to people that are way deep in a transaction and something didn't feel right from day one, and they didn't want to rock the boat. They didn't want to reach out. Or you talk to someone and you spend 30 minutes and they say, "Oh, this has been awesome. I really wish that our loan officer could have explained that stuff to us. But, you know, we're already deep into it and they're friends with the realtor. So we're going to continue down that path." Go with your gut. The person that educates you, empowers you, gives you the information you need to make excellent decisions and the right decision for you and your family. No one should tell you what is the right decision. They should give you the information to make those decisions for yourself. And when you find that person, if they have competitive rates and terms, go with them.
Good stuff. And one more question here. I'm just going to get to it. It's really quick. Willie says, would PMI protect a borrower if one of the other borrowers passed away and that borrower could no longer afford the mortgage payment? I know PMI is only for the lender, but is there ever a case where it helps? The answer is no. PMI would never help the borrower. In any case, it's to protect the lender in case you as a borrower, 2 borrowers, 3 borrowers, anybody defaults on that mortgage. It's there for the protection of them, not you. Really simple. But with that, guys, we appreciate you watching. We appreciate the support. We will see you next week. Adios.
Happy 4th of July, amigos.